Good afternoon. This is Joe Pryor of the virtual real estate team in Oklahoma City, and Henri, my toy here, toy poodle, is going to be in the video with me today and maybe help me out just a little bit. A couple of days ago, I talked about what constitutes returning to a normal market. We've had some upheaval, as you know, in the United States real estate market and economy. And some markets may be years away from returning to any kind of semblance of normality. Oklahoma, on the other hand, is not that case. Oklahoma was not a part of the bubble. We didn't have any fluff back in 2005 and 2006. So we missed that aspect of the meltdown. However, like any state and like any city, we certainly have been affected by it. In order to bring back real estate a bit in the United States, we've had a couple of artificial stimulus packages that have been brought into bearing, one of which was the original $8,000 tax credit in 2009, and then in 2010 it was extended and also included some existing home buyers. And so what the artificial stimulus did is take away the normal market cycle. Actually, the first one wasn't so bad. The second one, however, really hurt us in the respect that we had low inventory, and so we had a spike up in prices for people just wanting to get that $8,000, thinking it's free, which it wasn't. And then a kind of a drop that we had in a high inventory time of the year, like during the summer, when the buyers had already done their deal in order to get the tax credit. So it's taken till the end of 2010 for us to get back to buyers and sellers being in some sense of balance. We also saw a rise in pending contracts starting in November. That has continued on to today, and in fact January is looking pretty good. January is looking about like it was last year, but without a stimulus. And so that brings us to the normal market. And the normal market, as I explained, is when supply and demand are in balance. When there isn't too much inventory on the market, you're not oversaturated with inventory, you don't have a lot of repossessed properties. Question is, at that point, where are the buyers? And that's where we are now. We have the buyers, and I mentioned last time that now the most important thing that we think about when a house sells or doesn't sell is the price. Now, the typical way that realtors go into pricing a home is going back 6 months in time to houses similar, say in the same neighborhood or surrounding neighborhoods, and to determine what the comparable value is. Now, there's a couple of problems with that. Is in a fast-moving market like we have all over the country right now, 6 months can be ancient history. I think 90 days is a little bit more indicative of what to do about pricing. The second thing is we don't have good access to what the condition of houses are in those last 6 months. So we can't absolutely say what one is like versus the other, although it is important that we use this type of data. The most important data, I believe, going into a listing appointment and determining a price that a buyer is going to buy in a reasonable amount of time is absorption rate. And absorption rate is a very important thing that I think not enough realtors know how to compute. And it's not that difficult to really figure out what an absorption rate is. This is what's important about an absorption rate. It's now. It's real time. It's like if I have a house listed at $180,000, how many other houses like that are out on the market, and how many houses are selling like that over a period of up to a year? So here's very simply what I do. If I take similar houses, I take the number of active and pending sales. Now, you should put pendings in there, even though they may be under contract. They're indicative of the amount of inventory that's out there for sale. And of course, there's no guarantee a pending contract is going to close. So that's what we start with. So say we have 24 properties that are like ours. That's the beginning point. Then what I do is I take 3 different measurements, a 3-month, a 6-month, and a 12-month measurement of the number of houses that have sold. And what I want to see by doing those 3 different measurements is a timeline. I want to see if the market has stayed the same, is it improving, is it going down, and I want to calculate the amount of time it takes for the existing inventory that's out there like mine to sell based on solds. Now, the traditional number that we use for a neutral market is 6 months. In other words, if we're at 6 months of inventory, that's a balance between buyers and sellers. It's a decent market. And although I've seen other people go 6 to 12 months, is still somewhat neutral. I like to use 6 months because normally if I take a listing, people are ready to do something. They're either ready to move because of a job or there's another house that they really need or want. So for instance, if I take the last 3 months, which is really important, and I know that there are 24 houses like mine on the market, and only 3 have sold in the last 3 months, if we take that times 12, or excuse me, times 4, which would equate to 12 months, that would be 12 homes. So it takes a year to sell 12 homes by that computation. We have 24 houses on the market. That means there's a 2-year inventory of homes existing right now in order to remove those from the market. Now, very simply put, what that means is if you're a house, you're saying, well, I'd like to get more. I'd like to get 190, and I have 2 years of inventory on the market. I'm sorry, Mr. Seller and Mrs. Seller, you're not going to get that. And you're not going to get that because of the law of substitution I talked about last time, which is you can buy a cheaper house that's of equal quality and equal location. That's the one you ought to buy. Why should I buy your house at 190 when I can get the same thing for 170? $20,000 right off the bat is a good thing to start with. So again, when we evaluate a normal market and when we go into looking at what a house should sell for, or even if I work with a buyer and I determine whether a house is of value, then that is to me the most important thing, because that's going to indicate what it means to you in terms of how you should price your house on the market. If it's 3 months of inventory, man, I'm ready to go. Let's get after it. And that can happen. If it's 2 years, let's really evaluate that price. Let's make it competitive, and let's ask yourself the question, do I need to sell or do I want to sell? If you need to sell, then the price needs to be right. If you just want to sell, maybe the best thing for you is to sit until we get in your market to a normal market condition. This is Joe Pryor with the Virtual Real Estate Team, where we deliver traditional real estate values with the speed of technology.